The inventory was there, recorded, verified, every pallet accounted for on the digital ledger, and then, in a single keystroke, it was written off, as if it never existed. Welcome to the world of the invisible theft. In corporate boardrooms, we worry about cyber attacks and external hackers, but the most devastating leaks often happen right under the fluorescent lights of the warehouse. It's a game of shadows where millions of dollars in physical assets are erased from the books while remaining very real in the physical world. What if the inventory isn't lost? What if it was intentionally erased? Today, we pull back the curtain on the stock write-off scam, a sophisticated fraud that turns shrinkage into a weapon of mass financial extraction. This is corporate secrets. In any large-scale operation, stock write-offs are a legitimate and necessary part of doing business. Goods get damaged during transit, food items expire, technology becomes obsolete. Accounting standards like GAAP and IFRS provide clear frameworks for recognizing these losses. When a company identifies unsellable inventory, it must be removed from the balance sheet to maintain financial accuracy. It's a routine adjustment, a mundane task performed by thousands of inventory managers every day. But it is precisely this mundanity, this routine nature, that creates the perfect cover. When a process becomes a habit, oversight tends to soften. And in that soft spot of corporate complacency, the fraudster finds their opening. To understand the scam, we first must respect why the system exists. It is designed to clean the books, but it can just as easily be used to cook them. The vulnerability lies in the adjustment entry. Most inventory systems allow for manual overrides to correct discrepancies. While these entries require a reason code, be it damage, theft, or expiration, the actual verification of that reason is often the weakest link in the chain. In many organizations, the person who identifies the damage is the same person who enters it into the system. This lack of segregation of duties is a ticking time bomb. Think about the scale. A global retailer might process thousands of write-offs a month. If just 1% of those are fabricated, the cumulative loss can reach staggering heights. It's not a sudden heist, it's a slow bleed. A leak in the hull of a multi-billion-dollar ship that goes unnoticed until the vessel begins to tilt. We are talking about the manipulation of data to hide the movement of physical wealth. Meet Rahul. He's a trusted inventory supervisor at a regional distribution center. He knows the system's blind spots better than the auditors. The scam begins with the fake damage report. Rahul identifies high-demand, high-value stock, items that are easy to resell on the secondary market. Instead of reporting them as healthy inventory, he flags them as damaged during handling. To the system, these items are now worthless. To Rahul, they are pure profit. He creates a paper trail of destruction for goods that are in perfect condition. By the time the quarterly audit rolls around, the damaged stock is long gone, and the paperwork looks impeccable. It's a psychological game. By labeling something as trash, you immediately lower the level of scrutiny it receives. After all, who spends time auditing garbage? The second stage of the failure is the verification gap. In a robust system, any significant write-off should be physically inspected by an independent party, someone from finance or internal audit. But in the fast-paced world of global logistics, speed often trumps security. We don't have time to check every broken screen, they say. Rahul knows this. He waits for the peak season, when the warehouse is overflowing and the supervisors are overwhelmed. He submits his write-off requests in bulk. The busy manager, trusting Rahul's years of service, signs off without ever stepping foot on the warehouse floor. This trust-based control environment is the fraudster's best friend. When verification becomes a rubber stamping exercise, the internal controls are effectively dead. The system assumes the goods are destroyed, but in reality, they are merely waiting for the cover of night. While some operate alone, the most sophisticated versions of this scam involve internal collusion. Imagine Rahul in the warehouse partnering with Priya in the finance department. Together, they form an impenetrable circle. Rahul identifies the stock. Priya ensures the accounting entries bypass the usual red flags. They might even involve a third-party logistics provider, a ghost vendor, who is paid to dispose of the stock, but instead diverts it to a private warehouse. Collusion is the nightmare scenario for any auditor because it bypasses the segregation of duties rule. When the people designed to check each other start working together, the financial statements become a work of fiction. The conspiracy isn't just about stealing boxes, it's about stealing the company's integrity. And as the collaboration grows, so does the audacity of the theft. $10,000 becomes $100,000, and soon, the numbers reach the millions. The execution phase is surprisingly quiet. It happens on a keyboard. With the approval secured, whether real or forged, the inventory is officially written off in the ERP system. At this exact moment, the goods cease to exist in the eyes of the company. They are removed from the asset register. The stock on hand value drops. The cost of goods sold or loss on disposal account is debited. On paper, the transaction is complete. The company has accepted the loss and moved on. This digital erasure is the most critical step. It creates a clean break between the company and its assets. To an outside observer, everything is in balance. The books match the system, but the system no longer matches reality. The goods are still sitting on pallet 42B, but according to the digital ghost in the machine, pallet 42B is empty. Now comes the physical diversion. Under the cover of a routine scrap removal or after-hours logistics shift, the written-off stock is moved. It doesn't go to the incinerator or the landfill. It goes to an unmarked truck waiting at Dock 7. These goods, which the company believes are junk, are actually high-demand products headed for the gray market. They will be sold on eBay, through unauthorized wholesalers, or even back to the company's own competitors. Because the stock was written off, there is no missing inventory to report. The cycle is closed. The thief has the cash, the company has the tax deduction for the loss, and the market has discounted goods. It is a win-win for everyone except the shareholders and the integrity of the global supply chain. This is how physical assets are laundered into untraceable cash. The impact of this invisible theft is devastating. Beyond the immediate loss of the product's value, it wreaks havoc on supply chain planning. Sales teams promise products that don't exist. Customers face delays. The bullwhip effect is triggered, leading to over-ordering and even more inventory waste. But the real sting is the normalization of deviance. When managers see high levels of write-offs as just part of the business, they stop looking for the root cause. The theft becomes a budget line item. Inventory shrinkage is treated like a natural disaster, unavoidable and unfixable. But shrinkage isn't an act of God. It's an act of man. Every missing box represents a failure of governance, a crack in the corporate shield. When you stop counting what you own, you stop owning what you have. Let's look at the hard numbers. In one investigated case at a global electronics distributor, the cumulative exposure from fraudulent write-offs reached a staggering $13.2 million over 3 years. This wasn't one large heist. It was thousands of small adjustments, each one carefully calibrated to stay below the materiality threshold that would trigger an automatic external audit. $13.2 million. That is the cost of complacency. That is the price of trust without verification. For a mid-sized corporation, that loss represents the entire profit margin for a quarter. It's money that could have gone to R&D, employee bonuses, or shareholder dividends. Instead, it funded a fraudster's lifestyle. When we talk about corporate secrets, this is the secret that keeps CFOs awake at night. The realization that their biggest loss isn't a market crash, but a slow, silent drain from within their own walls. Why does detection fail so often? Because the scam is designed to wear the mask of legitimacy. Every fraudulent write-off is accompanied by paperwork that looks exactly like the real thing. There are damage reports, disposal certificates, and managerial sign-offs. To a remote auditor sitting in a different city, the data looks perfect. The controls appear to be functioning. This is the illusion of control. We rely so heavily on digital trails that we forget that data is only as good as the physical reality it represents. If the data says a pallet was crushed by a forklift, we believe it. We don't ask to see the crushed pallet. We don't ask for the forklift's maintenance log. The fraudster exploits our desire for efficiency and our trust in the system. They know that as long as the paperwork is in order, no one will look at the warehouse floor. The root cause is always a failure of internal controls. It's the lack of blind counts, where the counter doesn't know what the system says should be there. It's the absence of unannounced spot checks by the finance team. It's a culture where questioning a long-tenured employee like Rahul is seen as policing rather than protecting. Internal audit should be the source of assurance, not just criticism. When controls are treated as a check-the-box exercise, they are worthless. A lock only works if someone checks that it's actually locked. A camera only works if someone is watching the feed. In the stock write-off scam, the lock was there, but the key was left in the door. Weak controls don't just allow fraud, they practically invite it. To stop the bleed, we must move beyond paper audits and return to the physical truth. There are always red flags. You just have to know where to look. An unusual spike in write-offs at the end of the quarter. A specific employee who always seems to find damaged stock in the highest value aisles. Reason codes that are used repeatedly, like expired, for items that shouldn't expire, or write-offs that consistently happen just before a scheduled physical inventory count. These aren't just anomalies, they are the fingerprints of a fraudster. Data analytics can help identify these patterns, but it takes a human mind and investigative intelligence to connect the dots. If your scrap account is growing faster than your sales, you have a problem. If your best-selling items are also your most damaged items, you have a problem. The signs are there. The question is, are you brave enough to follow them? The lesson is clear. Inventory must be verified, not just recorded. The golden rule of asset protection is trust, but verify. This means regular, unannounced physical inspections. It means rotating staff so no one person has permanent control over a single warehouse zone. It means integrating your ERP system with weight sensors or automated disposal tracking. But most importantly, it means changing the corporate mindset. We must view the warehouse not as a cost center, but as a vault. Every item on that shelf is cash. If you wouldn't leave a stack of $100 bills uncounted and unmonitored, why would you do it with your stock? Professionalism in auditing isn't about suspicion, it's about stewardship. Protecting the company's assets is the highest form of service. When we verify the truth, we protect the future. But here is the final, chilling realization. The real risk isn't just one employee or one fraudulent write-off. The real threat is a systemic culture that allows theft to become invisible. In our investigation, we found that once a scam like this takes root in one branch, it spreads like a virus to others. If Rahul can get away with it there, why can't I do it here? A lack of accountability at the top creates a vacuum at the bottom, and that vacuum is quickly filled by greed. The invisible theft can bankrupt a company before the first official investigation even begins. It's a battle for the soul of the organization. Are you watching the shadows, or are you just looking at the books? The choice you make today determines the security of your tomorrow. Because in the world of corporate secrets, what you don't see is what will destroy you. If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets.